Welcome to another edition of Chart Talk. I'm Tony Ogorek. I'm here with Jeff Viksjo. And today, Jeff, we're going to be talking interest rates. Market, many prognosticators seem to think that interest rates are, or they're actually hoping that interest rates are going to be coming down in the very near future. We, however, have a different idea, and we have some pretty good company known as the Federal Reserve. So we've got a few charts to look at. Let's take a look at the first one. What do you see here?
Yeah, the chart on the left shows the Fed funds rate since about 2000. And you could see when the Fed did bring it up in the past, 20 years or so, they quickly brought it back down again because something really bad happened. And the first one was the Great Recession in 08, 09. And then we had COVID where they started to bring it up in 18 and some in 19 had to bring it back down to zero. And so the thought now is, yes, they brought it up really quickly, but the market was thinking, well, yes, but we'll have a recession. And so they'll bring it back down very quickly again.
Right. So they're sort of looking at things myopically, very, very short term based on what's happened over the most recent history. But as the Chinese say, a picture can be worth 1,000 words. Let's take a look at our next chart. This was not something from one of the vacations that we've been on. It's actually from it's Tabletop Mountain, rising over central Cape Town. And I think this is sort of a metaphor for what we see happening in the future. So on the left side of the mountain, you'll see that, it's moving up, but then you've got an extended plateau at the top, before it begins to descend. And I think that's probably going to be a pretty good metaphor for what's happening now, because, Jeff, the Fed, rose rates probably 5.5% in the shortest period of time they've ever done that. And it hasn't had enough time for all those increases to really have a biting effect on the economy. But I think that is going to happen the longer they leave rates higher. Wouldn't you agree?
Yeah, and we've seen this manifest in longer term rates rising. So previously, 3 months ago, the short term rates were very, very high, but the longer term rates were still low because eventually they thought the Fed would bring rates down. We've seen those longer rates now creep up, and that's what's sort of shown here in that picture, that rates are going to stay higher for longer.
Okay, we've got one more chart, and this one is really a cool one. It goes back to 1790 and it looks at the 10-year rate, what the average, yield has been over a couple hundred years. And, bottom line is, what we've seen recently over the past 10 years since the global financial crisis is really an anomaly, isn't it, Jeff?
Yeah, if rates feel high because they've just been so low. But if you look back since the start of our country, where we are now is just right at the long-term average.
Yeah. So what you're seeing right now is normal. What we've been seeing for the past 15 years has been sort of abnormal. And really what we've been seeing since that big spike, over the past 40 years where we had this massive bull market in bonds, that also has been abnormal. So we're in a different investing environment. We're making adjustments, and we just wanted you to see what we see. So thank you, Jeff, and thank you for joining us for this edition of Chart Talk.